Welcome, everybody. I'm just waiting for Mark to log in with the link, and then we're going to get started. This is in webinar format, and what we're going to do is we're going to just present some brief information. I'm going to actually, since we have a small group, I'm going to just invite everybody up to talk. Please understand that I am recording this, and it will get posted. So I would like you to hold off on getting too personal with your questions if possible. We can actually shut the webinar down, save the recording, and then we can, do a chat, or I can just stop the recording and then we can have a real chat. So let's go ahead and get this started. Mark is here. I'm going to promote him to panelist, and we're ready to go. So this is fun with taxes, right? I don't know, fun with taxes. Today we are going to talk about 3 different areas. Short webinar, we can't really touch upon everything. So, hey, Mark. There you are. Hi, you can just unmute. So I'm going to let our attendees, I'm going to promote everybody to panelists so that they can come in and talk with us. And if you don't want to be on camera, that's fine. If you could mute yourself while you're not talking, that would be great. I love it. Okay, so let me see. Okay. Okay. So Nancy was the only one that wanted to come up as a panelist, but if you have questions, go ahead and put them into the Q&A or the chat. We'd be happy to answer them as we go along. So we'd really like this to be informal and not, presented as a big, with slides event, because the 3 areas that we want to talk about today are, we're going to talk about the Secure Act and the final Secure 2.0 regulations and make sure that everybody is on board with what they need to do. We're going to talk about how trusts get taxed now that we're right in the middle of tax season. And we'll do that in some general terms. Happy to talk in more detail if people would like that. And then we're going to talk a little bit about able accounts. A lot of times when I'm talking about trusts, people want to lump in their able account questions as well, because there's a lot of tax regulations around able accounts. So I thought we would have a little chat about able accounts too. Okay, let's start with the tough stuff, Mark. Let's start with Secure 2.0. Where are we now? We started this journey at the end of 2019, and where are we now with Secure 2.0?
Okay, well, Secure 2.0 is Congress's funny way to label some modifications to the Secure Act. But we had Secure became effective for deaths on or after January 1, 2020. Secure 2.0 came in at the very end of, when was it? I guess it was the end of 2022. And then, but more important than the Secure 2.0 was the proposed regulations in February of 2022, which have still not become finalized yet, but we're all treating them as though they were final regulations. Anyway, so latest is for Secure 2.0, they changed the required beginning date, meaning when do you have to start taking minimum distributions out of your own traditional retirement plan.
Mm-hmm.
If it's a Roth plan, doesn't affect that because there are no minimum distributions during the original owner's lifetime from a Roth. It's only after the original individual owner dies, unless it's being left to a spouse, and the spouse elects a spousal rollover. But the RMD now, if you, the required beginning date rose to age 72. used to be 70 and a half, or technically April 1st of the year after you turned 70 and a half. Then it got bumped up by to 72. Now, if you were born between 1951 and 1959 inclusive, your required beginning date will be April 1st after the year in which you turn 73. And then if you were born in 1960 or later, it'll be April 1st after the year in which you turn 75.
Cool.
So
But required beginning date doesn't mean that you can't start taking distributions earlier if you need them, right?
that's right. Or even if you don't need them, sometimes it makes sense to do that. Um, for various reasons, you may want to, uh, well, I guess we don't need to get into all the reasons, but it can sometimes be a good idea to start taking them out early.
Mhm.
Um, the
So, so now
so
let's
you want
talk about, so we've got the required beginning date, which is not the minimum distribution amount. So we've got the required beginning date at 73 and going up to 75 for batches of people. Okay. So what else in Secure 2.0?
well,
Especially the regulations, because the regulations were what clarified for us what we thought was happening anyway.
yeah,
Talk
Secure
to us about
2.0.
special needs trusts.
So Secure 2.0 did some fun stuff from my point of view, but most people won't. There are things that matter to little pinheads like me, and then there's stuff that matters to clients, but it matters to clients only if they only knew about it. So for example, it used to be that if you had a third party supplemental needs trust for your kid. So you die, you leave money in this SNT for your kid, your disabled child, and if it's done right to comply with the Secure Act, it the unlike the 10-year rule, which we have for most retirement plans now, uh, the S&T could take out the um, required minimum distributions over the remaining life expectancy of the disabled child. Um, Many of our clients will leave money at the death of their disabled child to one or more charities.
Mhm.
There's a much greater propensity for parents of disabled children to do that than for other clients regular estate planning clients that I had before I really specialized in special needs planning. So that was a problem for retirement plans before the Secure Act,
Mhm.
or actually before the proposed regulations, because you couldn't do that with the retirement plans. You couldn't do that with the retirement plans or the accumulation of withdrawals of the retirement plan that were still in trust.
So just to reiterate that to make sure I understand it, previous to the regulations, you could not have a charity be the final endpoint for the IRAs
Yeah,
after the disabled person's death.
even if it was a remote possibility, like,
There
gee,
might be
if you
nothing
like
left at the end.
if half the planet dies, then it'll go to this charity. That could kill the that could kill the lifetime payout. So the proposed regulations made things better, and so that, okay, well, if the charity would only take after some individual that would take after the charity,
Mhm.
okay, and that was just a snapshot at the IRA owner's death, so that even if that individual died before the disabled beneficiary died, so the charity moved up to being the actual taker after the death of the disabled beneficiary, that was okay. The um, Secure 2.0 made that even better, so that you can just directly name a charity as the immediate beneficiary after an SNT.
Mhm.
And it won't affect the ability of the S&T to take out minimum distributions over the life expectancy of the disabled child. So that was pretty cool.
So now you can have a charity as a remainder beneficiary after your disabled child.
Yep.
Okay. So let's talk about that stretch. Let's kind of take a step back for folks who maybe don't know all the goings
Right.
on of how a trust can inherit an IRA for the benefit of a disabled person.
So history lesson: before 2020, which is when the Secure Act became effective, you could have retirement plans left to trust. And if you knew what you were doing, you could have that retirement plan pay out over the life expectancy of whoever the oldest beneficiary was that could possibly take under even the remotest possible circumstances could ever inherit a dime from that IRA, and not just directly, like if the trustee pulled out money of the IRA and just sat on it and invested it for a while, all of that money you had to look at, well, who's the oldest possible person who could ever take it?
Right.
Secure um, changed things so that now, with a few exceptions, money in a retirement plan, a deferred tax retirement plan like an IRA, 401k, etc., had to come out within 10 calendar years of the death of the owner, unless it was left. Well, so one of the exceptions, which was always an exception, was to a surviving spouse. And there were a few other exceptions. The ones that we care about for the most part are disabled or chronically ill. There's a lot of overlap in those two categories, but they're not identical. But disabled or chronically ill. And the before that bill got finalized and signed into law at the end of 2019, there was some interference by the not interference, but a sweet little letter went out from the National Academy of Elder Law Attorneys to the House Ways and Means Committee that said, we really appreciate this, but most of these people need a special needs trust, and that won't qualify. Could you kind of tweak your language a little bit so that it can work? And they did. So that was really awesome.
So now we can leave money to a special needs trust. And what is the benefit of leaving an IRA or a 401k or any qualified retirement account to a special needs trust?
It gets to use the life expectancy of the individual, the disabled individual, as the measuring life to pay out over their life. So if it was a 25-year-old, if you died when the individual was 25, and it doesn't have to be a child, it could be a grandchild, it could be somebody you just like an awful lot, and you're setting up
Right.
a special
That's
needs trust for
important.
them.
It does not have to be your child. It can be
No.
your cousin. It can be your neighbor. I mean, whatever
So it
planning that you're
just
doing.
has, so there's a few requirements, but anyway, so like the person who's 25 years old, their life expectancy under the tables is about 60 years, 60 more years left. So about age 85. So the tax deferral that results from that, the income tax deferral, is not just kicking the pain of tax down the road, not just kicking that can down the road. If you work through the mathematics, it's actual more real net present value after tax money for your beneficiaries. And if it's a long time, like decades, it's a fantastic amount more, like many times, many multiples more real money for them. So it's pretty huge. Another thing is that trusts trusts that are taxed as trusts, which is most of them after you die, uh, uh, Congress gave us a lovely gift in 1989, and then even tightened it up in 1993, where trusts were no longer had the kind of tax brackets that individuals do. They have the same rates, but the brackets are very compressed. So an individual hits the top income tax rate at about $550,000 of annual income. A trust hits that same amount at about 14,000. So by having less taxable income forced on the trust, which a 10-year rule would do, the trustee is much better able to handle the taxation and how the money comes out. Because another cute thing about trusts is that if the trustee makes distributions during the year to or for the benefit of a beneficiary, it carries out taxable income. So if the trustee takes out a minimum distribution of $10,000, but distributes, pays out $25,000 worth of benefit, various benefits for the individual that year, it carries out the $10,000 of taxable income away from the trust. It gets taxed on the beneficiary's tax return, which will probably be at zero or a very, like maybe a 10% tax rate. It's very low. So lots of advantages to doing that. Even more spiffy and awesome is if you leave a Roth IRA or Roth 401k to a special needs trust that qualifies under the Secure Act. You get this tax-free buildup over, whatever, some 60
20
years
or
or
30
whatever.
years is the average.
And even
20 to 30 years.
when the money comes out, it's not taxed at all. So it's like one of the great tax deals left.
Yeah.
At all.
Even a smallish account could really be stretched by doing this planning and thinking about your assets that you have and how do you want to leave your assets. Many families will say, well, I want everything even. Sure, but you might want to equalize it so that one asset goes this way and one asset goes that way, and so on and so on. It's a little harder to do it that way because you don't know what the size of that asset's going to be when you die, and you need to be vigilant and stay on top of it.
Or what we do is we leave everything to we typically have people leave everything to their Rev Trust, and in the Rev Trust we have a formula that if you want everything to go equally among 3 kids, we can do that, but then have the retirement plans allocated to fill up that 1/3 bucket of the special needs trust. We can allocate the retirement plans over there preferentially so that the best kind of assets get put over there. So like we'll put the Roth IRAs over there first and and like that.
So Mark is an amazing planner and drafter, and not every planner or drafter is going to be able to get that intricate with your documents. Also, he doesn't like it when I say this, but the more intricate your documents are, you have to be very thoughtful about who the trustee is going to be and who the estate administrator is going to be that carries all of this out. There's enormous, I don't want to say problems, but responsibility when you have retirement accounts, multiple layers of trusts, and estate administration going on. The administrator of the estate has to really know where all the buckets are going to go, set up the accounts properly, etc. So as the trust administrator in the family, I'm going to just tell you a couple of things from the practical side of things when you end up being the administrator and then the trustee. What happens is you have to have 2 separate buckets set up for the retirement account and then the money that's coming out of the retirement account as the required minimum distribution. You may or may not spend that required minimum distribution money, but it needs to leave the retirement account and go into the main general trust principal or corpus. And tracking this, can be a little complicated. So you want to say to me, oh, but wait, Annette, I have amazing wealth managers who can help me do all of this. I have a great CPA. Most of them are just as lost as the average person when it comes to really understanding how to set up these buckets and how the flow of the money is going to be in order to take advantage of these wonderful tax benefits or opportunities. Once it's set up, it does still require that annual maintenance. If you are leaning on your wealth advisor to do your required minimum distribution calculations, there's a not so small chance that they're going to get it wrong, and not start when they're supposed to, and not have the measuring life correct. So it would be great if you want to take advantage of this opportunity to just have in your circle of care on your team someone who really is an attorney or who is very knowledgeable in this field, who can do the calculating and get this all set up for you. It's a small lift.
I mean, I would say, once it gets launched, it's not going to require constant attention, from an attorney who, really knows or is expert on the retirement plans. I mean, that's my view. I think
as long as you've got the bucket set up at the beginning properly and the money's flowing correctly. So another thing as an administrator, I want to tell you is that many people get very anxious about the idea that this income tax liability is going to flow out to their person, whether they take the money or not. And, how is that going to impact their public benefits? How is that going to impact their tax payments? How is that going to complicate their life? Because most of our people would not meet the filing threshold, never mind owe tax. A lot of times we're pushing people into the filing threshold, but they're still in that donut hole of having to file but not owing any tax. And yes, this levels up the complexity, but as Mark said, we have so much benefit. I mean, the benefit on even a small retirement plan is enormous. And if it's a Roth account, it's even more so. That it is probably worth doing this intricate planning for just about anybody who has a retirement plan that they want to leave. So that's my little administrator hat. And, all you need to do is make sure that your person has a decent CPA, that you've really selected a trustee carefully, and that you're thinking through how you want to leave your assets.
I just need to say one thing though, that I kind of skipped over at the beginning. So not all third-party supplemental needs trusts or third-party special needs trusts, however you want to call them, will qualify to be able to avail itself of the lifetime required minimum distributions under the Secure Act. So in order to do so, I'm just going to hit the number one key
provision.
Key feature is that the disabled person, or it can be more than one, but the disabled persons can be the only beneficiaries of the trust for the longer of their life expectancies, if there was more than one. But let's say it was just a single person. It can't say that, oh, hey, like you can make distributions for this my disabled kid, and oh, by the way, although that's where my primary focus is, hey, if it makes sense, the trustee can make distributions to her for the benefit of my disabled child's children or my disabled child's siblings or whatever.
or my cousin.
or whatever. No can do. Has to be restricted to them, at least with respect to the retirement plans and all of the accumulated withdrawals from the retirement plans.
So this means it's time to get your trust reviewed if you haven't done that over the past couple of years, because many of us as planners have been screaming at our clients, please have your plan reviewed. Some plans that were drafted are still going to qualify, even though,
Yeah,
you may
they
not
just
have,
happen to qualify,
they
right?
just happen to qualify. So it's really good to, at this time, just take a minute, dust off that nice, pretty binder with all those documents in it, and take a trip down to your estate planner and see, does everything still work? And are your goals even the same? Your goals might change now that I've told you that this is the best thing since sliced bread when it comes to retirement plans and disabled people. So you might have a different view on how you want to split your assets. I'd love to move into able accounts next. If you have questions, go ahead and throw them in the Q&A or the chat, and we'll get to them. And I want to shut the recording off before we do that. So able accounts, just a few brief things. We've been updating regulations about able accounts for about 5 years now, actually longer, since 2017, I think. And we're done. We have the final. The key numbers to know is that it's tracking with the annual gift tax exclusion. So this year you can put $18,000 from all sources into an able account.
All sources combined.
All sources combined.
Including
right?
the disabled individual.
The exception, which we still have for 2 more years up until the end of 2025, is work income. If there is work income, they can contribute work income up to a certain dollar amount, and that's state specific because it is based on your state's oh shoot.
No. Well, no, it's the it's key to the poverty level.
Right.
But
But
so it's only Alaska and Hawaii that are different, right?
So just make sure that you know what that number is. And if your person has earnings under that, they can contribute all their earnings. If they have earnings over that number, they can contribute up to that number.
Unless they're covered by a retirement plan at their employer.
There you go. So you cannot contribute to both. So, but that is very unlikely for most of our people. They're working part-time, they're working a minimum wage job, and they don't have the opportunity to contribute to a retirement plan. But so you can still contribute to an able account up to that $18,000 this year from all sources combined. You just can't take advantage of the work income exception to go over that amount. Anything else that we need to note?
Yeah. 2 things.
You know what?
Yeah.
The age 46. So
Yep.
we're going up in 1 more year. We're going up to age 46.
So in 2026.
So starting at the beginning of 2026,
Mm-hmm.
the start date for disability can be up to age 46.
Right now
you
it's
can still avail yourself. It's
yeah, so
26.
up it's 26. And it has been 26 up since the beginning of the able account legislation was passed in 2014. So it's moving up from 26 to 46.
And that was a very strong lobby effort by disability organizations all over the country that said, hey, what about the person who has the car accident when they're 30?
Mm-hmm.
What about the person who has cancer when they're 38? What about the person at 42 who has MS? I don't know why they picked 46. It seems like they just don't want to get close to elderly and issues of aging, but that's where we're at now. Any other thoughts that you want to mention about able accounts, Mark?
The only other thing is that let's see, I just want to make sure I've got this right. Yeah, another thing that ends in 2026, so in other words, it's only good this year, next year, is that you can roll. So suppose you've got 529 plan balances that you look at and you go, oh, like we're not going to use these because, like I have one for my typical kid, but
Mhm.
he's done. He's like all through college. He's not going to go to graduate school or whatever. We're all done. What can I do? Or somebody set up a 529 for a disabled child, but disabled child is not going to be using it
And
for
in case you
529
don't know,
purposes.
that's an educational savings account,
Oh
in
yeah,
case
sorry
you don't
about
know
that.
what a 529 plan is.
So that can be rolled over to an able account this year and next year if it is the 529 plan of the disabled person or a family member, with a slightly complicated definition of what that means, but I won't get into that here. And but again, that counts towards the $18,000. So if you've already got in mind to shove $18,000 in from other sources, like you got no more room left.
Yeah. So just a brief note, why do people use able accounts? Or even better, why should people be using able accounts? Okay, a couple of things. Actually, I've got a handful of reasons. But remember how Mark was telling you that Roth accounts, they grow tax-free and they come out tax-free? Well, able accounts have a triple threat. You can contribute to them as a disabled person yourself without a transfer penalty for any public benefits. They grow tax-free, and as long as they come out for qualified disability expenses, they come out tax-free too. So you get all that growth, and then you're able to take the money out. One of the so I just posted a blog post in two different forums here on the Circle of Care, and it's about using able accounts as a down payment on a house. So it's actually more popular than you would imagine. Able accounts are a great way to save for things that you normally wouldn't be able to. And, um, for example, saving for a car, saving for a trip, saving for, you know, your rent. When you go to get a new apartment, for example, many times you're paying three different payments: first, last, and security deposit. Depending on where you live, that can be thousands and thousands of dollars. Nobody is allowed, if you're on certain public benefits, to keep more than $2,000 in your account. So you want to be able to save up for those things in a penalty-free, transfer penalty-free way. So able accounts are great for those reasons.
There's well, if you're done with the reasons, can I throw in another one or
I'm
two?
not done with the reasons yet.
Okay.
One other reason is that Social Security and Medicaid, they actually really like these able accounts way more than they like trusts. They have been promoting able accounts. They want people to save in able accounts. It's got a lot to do with independence and self-determination. And you just don't get the kind of questions and interrogations that with an able account that you get when you have a funded special needs trust. There's more, but go ahead and look at the able account article, and there'll be other able account articles that I'll be posting in the very near future. Okay, Mark, what did you want to add to that?
Well, another one is that when an able account pays for things for the owner, the disabled beneficiary, it's not it's not deemed income for federal public benefits purposes, including state programs like Medicaid that are joint federal state. That can be very huge when it comes to certain things like housing. Another is well, we call it the stinking dead body rule, but we don't need to get into that right now.
So another thing, many people will point out that ABLE accounts do have some recovery by the Medicaid department in your state at the end of your person's life, if there's any money left in there. They are only able to recover from the time that the account got established. So whatever bill has been accumulated from the time the account got established to the time the person passes away is the only recovery that they're able to do. Whether that's a week, a month, a year, 10 years, doesn't matter. That's different than a self-settled special needs trust called a D4A trust, which starts from birth and accumulates the lien. There are many states now, Massachusetts is not one of them, that have basically removed the state Medicaid agency's ability to recover from ABLE accounts, not from self-settled special needs trusts. You see, there's a bias here. So ABLE accounts are just great as an addendum or an add-on to your plan. They will never replace special needs trusts.
Also, if I'm disabled and I'm 66 years old, can I fund a D4A trust?
No, but you can fund an ABLE account
Yes,
as
I
long as
can.
you were disabled prior to age 26 and soon 46. So it can be a really good strategy for many people as they age and they need to move funds in order to qualify for home and community-based services or even institutional services that do have a $2,000 asset limit. Okay, moving on. Let's talk about how trusts are taxed. Woo, this is fun. So it can be very confusing for people because they really want to talk about qualified disability trusts, which, you know, is just a small part of how trusts, special needs trusts, are taxed. Let me just talk first about the two different kinds of trusts. A third-party trust funded with other people's money, not the disabled person's own money, is going to get taxed depending on what income was accumulated or was earned inside the trust during a calendar year and how much of that income got carried out on the shoulders of a distribution. So think about it like a little kid sitting on your shoulders, and that little kid walks out the door with you. Well, that's the tax liability walking out the door of the trust with the trust distribution. Doesn't matter if you distribute $1, $5, $1,000, $1 million. The tax liability will be tied to only the portion that was distributed out to the beneficiary or for the benefit of the beneficiary. So let's say that this year in a third-party SNT, I had $1,000 of income inside the trust for this calendar year. And I made two purchases for the beneficiary. One, I gave them $100 for spending money for an event. And two, I spent $400 on a new TV that I had delivered to them. So $500 total. Both of those items on behalf of the beneficiary are going to carry out tax liability with them. Look, this is a very simplified way of explaining it. And believe me, there's more details, but this is essentially the idea. $500 goes out to be carried out on a K1, which is, you know, similar to a 1099, and it's going to get reported and potentially taxed on the beneficiary's personal tax return. $500 of income stays inside the trust and gets taxed at the trust tax rates. That's how third-party trusts work and how they get taxed. First-party trusts, which are our D4A trusts, those are self-settled by the beneficiary. Those trusts are what's known as a grantor trust, and everything gets carried out to the beneficiary, whether a distribution was made or not. Mark, do you have anything to add to that before I get to qualified disability trusts?
I just want to make sure that we're clear with everyone that by self-settled, we mean that the beneficiary, or a beneficiary at least, and the person who put money into the trust are the same person. So in other words, there could be a D4A trust, but grandma funds it. That's not going to be a grantor trust.
Mhm.
But most D4As are going to be grantor trust because it's the disabled beneficiary's money that goes into it.
So I'm just going to tout that Mark is actually a national expert on grantor trust rules. And we chuckle sometimes when a public CPA, a certified public accountant, or a financial advisor will tell us that on the face of a document, on the face of the trust document, this is a grantor trust. You cannot determine what is a grantor trust on the face of a document. You have to understand where the funding came from, where the assets came from.
Yep. If you're old enough to have seen All the President's Men, the movie, you remember what Deep Throat said. Follow the money. You have to follow the money in order to know.
And
The other
it's
thing I just wanted to quickly mention, I get always worry about oversimplifying things, and yet now we lead people astray if we do. For most trusts, most states, what we talked about, the distributions carrying out taxable income, it carries out taxable ordinary income, meaning interest, dividends, rents, royalties. Capital gain typically gets stuck inside the trust
that's right.
unless you've emptied so much of the trust that that's all you got left. Then it starts to carry out capital gain.
And if you've been a good trustee and done, some decent investing, you probably don't have that problem.
And capital gain too. I mean, even if it's in the trust, right, it gets taxed at, something like, half or so of the rate of ordinary income. So it's not quite so bad.
So your grantor trust, which is your D4A trust, is going to carry out income on a grantor trust letter to your beneficiary that your accountant, hopefully, will be providing. Both the K1 and the grantor trust letter let the beneficiary know with their accountant what they need to report on their personal tax return. Your trust, if you are a trustee, this trust can pay for the beneficiary to have their personal taxes done because of the complexity. And that's just going to be another distribution. So let's amend what I told you earlier. We had $100 that got sent directly to our person. We had $400 where we bought a TV. And then we had $500 that we paid the accountant to prepare the personal income tax return, not the trust tax return. Now we have $1,000 of distributions on behalf of the beneficiary. Okay, I want to stop here. I'm going to stop the recording, and then anybody that wants to talk can raise their hand and I can allow them to talk, or you can go ahead and use the chat or the Q&A.
Did you want to say anything about qualified disability trusts?
Oh, geez, I forgot about that. Yes, I do. Go ahead, Mark. How do
Well,
you know if you have a qualified disability trust?
okay,
And
so
why do we care about that?
the what the fun thing is that you also don't know from looking at the four corners of the document that can change every year. So here's the dang deal about qualified disability trust. So you may or may not recall that back in the old days before 2017 or 2018, whatever it was, in addition to the standard deduction, we also had on our individual income tax returns a so-called personal deduction, or personal exemption rather. I think the last it was maybe, I don't remember what it was. 4,000 bucks or so, something like that. But then the Tax Act of 2017 killed it, but gave us a much bigger standard deduction if we opted to take that. Trusts, ever since, I think 1954, the 1954 Tax Act, most trusts, not grantor trusts, but most trusts, like, you've created a trust for your kid and you die, and then the inheritance is in there. Third party special needs trusts. Most trusts where the grantor is not still alive have no standard deduction, of course, and have a hugely generous, amazingly large $100 personal exemption, unless it's a qualified disability trust. So this came along, I think, in 2001. We still have no regulations for it, by the way. But the qualified disability trust. So if all of, here's the main thing. If all of the beneficiaries of the trust, as of the close of the tax year, that's going to be December 31st, are determined by Social Security to have been disabled. So they need they can't just meet the definition of disability under the Social Security Act. They have to have actually been determined by Social Security to be disabled. It doesn't mean they have to be receiving anything. So, for example, suppose they're determined to be disabled, the only thing they could qualify for would be SSI, but they're over asset or over income, so they may not be getting any Social Security benefits, but they can still be determined by Social Security to be disabled. So if all of the beneficiaries of the trust, and what that means is the current beneficiaries, not remainder beneficiaries who are going to take when the current beneficiaries die, all the persons who are this year eligible, excuse me, all of the people who on December 31st were eligible to receive distributions from the trust, if all of them at some point, even for a day during the calendar year preceding, were determined by Social Security to be disabled, now you got a qualified disability trust. Well, so what? Well, here's so what. So first of all, it gets a personal exemption. It still doesn't get a standard deduction, but it gets a personal exemption, the same as an individual would have gotten had the personal exemption never been repealed by the 2017 Tax Act. For this year, was it last year? I think it's this year. It's $5,000.
That's
So right away,
huge.
no, first $5,000 of taxable income off the trust gone. Here's another spiffy thing. Have you ever heard of the kiddie tax?
I have.
Oh, yeah. Well, good. Somebody in the audience responded. So the kiddie tax is this. Let's say that I think to myself, well, I'm going to I know I'm going to give my kids some money, and they are going to invest it, and they're going to earn interest and dividends and capital gain and stuff, and it'll be taxed to them instead of me.
Mhm.
So I'm Jeff Bezos or somebody like that, and my income tax rates are at the top of the brackets and everything, and I'll give it to my kid. And okay, no. The kiddie tax says if the kid is under a certain age, and it's depending upon circumstances, it's somewhere like between I think 19 and 22 or something like that. If they're under that age, any unearned income, so in other words, they didn't work for it, any unearned income is taxed at the parents' rates. And okay, so that's the kiddie tax. Guess what? Distributions from a qualified disability trust, when they carry out taxable income, it is deemed to be earned income, and so does not get taxed under the kiddie tax rules.
So that's amazing because we do have young people who have trusts sometimes, and it's been huge. Um, okay, so qualified disability trusts are great. You really need to know from year to year if you have someone who is disabled, Social Security qualified disabled. Um, there aren't going to be too many people who are going to be qualified but not receiving benefits, but it can happen. And
But
ultimately,
but
you,
remember what I said the problem was for the Secure Act, right? You got anybody who the trustee has any discretion to give money to who's not who's not Social Security disabled,
Mhm.
and it's not a qualified disability trust.
Now you can have a special needs trust with a person with a disability and they don't qualify for Social Security. So the real problem with this, and then I'm going to switch off and go to questions, is that Social Security doesn't do the disability evaluation first. In most circumstances, they are doing the financial qualification. So if you get turned down because you make too much or you have too much in assets for SSI, for example, you are not going to get to that disability determination. So it's a little
Can you
bit of
get
a
it?
chicken and an egg.
Can you get a disability determination by asking? If you don't, if you fail
No,
financially, can you still get one
you can't
anyway?
even, no, I don't mean to be rude, but you can't even get them to do the job that they're supposed to do. So no, they're not going to do this. So the disability determination, it doesn't go to the DDU until it follows a very specific process. So you could have somebody that was qualified disabled by Social Security and later lost benefits
For financial reasons.
for financial reasons. But if you are looking at an initial application, that's a problem. All right. Thank you, everybody. I'm turning off the recording now.